Good afternoon, everybody, and welcome to what is another first in these times of unprecedented first, which is a webinar. My name is Michael Hansen. I'm the Chief Executive of Cengage. We are the largest education and technology US-based company, and I'm personally delighted to be joined today by Greg Mankiw. Professor Mankiw, as you will all know, really doesn't need an introduction, but I thought he still might enjoy one, which is he is not only a very prolific writer and a participant in the academic and policy debates. He has written two very popular textbooks, one, The Principle of Economics, and that has sold over 2 million copies, and he has also written the intermediate level textbook, Macroeconomics. But in addition to his teaching, research, and writing, Professor Mankiw has been a research associate of the National Bureau of Economic Research. He has been an advisor to the Congressional Budget Office and the Federal Reserve Banks of Boston and New York. And from 2003 to 2005, he served as the chairman of the President's Council on Economic Advisors. And needless to say, he is currently the Robert M. Byrne Professor of Economics at Harvard University. Greg, welcome very much to this seminar.
Oh, thank you, Michael. It's great to be with you.
Greg, in these highly uncertain times, I think everybody, and I think our attendance level, is proof of that, is looking for a lot of answers in highly uncertain times. And we have gotten a lot of questions in anticipation of this particular webinar. And the first question that really has risen to the top is, so are we in a recession, and how bad is it?
Well, the official arbiter of when recessions start and end is the National Bureau of Economic Research. They have a group called the Business Cycle Dating Committee that I was once a member. And they haven't declared it a recession yet. And that's because they really wait for all the data to come in so they can be very confident in their judgments. So they're very much of a lagging indicator of what's actually happening in real time. There's no doubt in my mind that this will eventually be called a recession. It started, we've seen 1 quarter of negative growth. The next quarter's going to be, the quarter we're in, is going to be horrific in terms of negative growth. So at some point, the NBR will come and declare this a recession. It's probably going to be the steepest recession in recent history, in the sense of the decline is so fast. I mean, last month's employment population ratio was the steepest decline in employment since the data begins in the 1940s. And that doesn't even include the carnage of the past few weeks, where things are going to have gotten much worse. So we have this record drop in the employment population ratio. That's going to be broken next month with an even bigger drop in employment. So this is a very, very steep. It will probably be the deepest one since the Great Depression as well. One thing to keep in mind, by the way, when you're looking at the employment data, is unemployment's going to go up high, but well over 10%. But that's not going to fully reflect how bad things are, because some of the people who are stuck at home and can look for jobs will be counted as out of the labor force. So in some sense, it's going to be even worse than the unemployment data suggests. So you have to look at the employment data, which is the employment population ratio, and that's going to show a very steep decline. How long it will last, we don't know. All the measures of uncertainty we have say we live in a time of particularly high uncertainty. If you look at some measures that Nick Bloom has developed at Stanford, or things like the VIX index, which is a stock market-based measure of uncertainty. We live in times of high uncertainty, but there's no question that these 2 quarters will go down in history as being particularly dramatic.
And then people, Greg, are kind of always grasping for like historical comparisons, how bad is it, and most of us don't really remember, thankfully, the Great Depression, but how would you compare it? I mean, is there any comparison, or is this so unusual that there's really no point in trying to compare it?
Well, I think this is unusual in a lot of ways. I think in terms of macroeconomic numbers, like GDP and unemployment, you can compare, and I think this is going to look a lot like the Great Depression in terms of the depth of how it's widespread unemployment that falls in GDP. So it's going to sort of get in that ballpark. Maybe not quite as bad as the Depression, but certainly it'll be the worst thing since the Depression. The one thing that's very, very different about this recession. It's not really a recession by accident. It's a recession by design. I mean, most of the times when we have a recession, we want people to go back to work. We're trying to figure out, okay, how can we stop this from happening? We need to get people back to work as soon as possible because we have a lot of unused resources, and that's just a waste. Well, now we actually don't want people to go back to work. We want a bunch of activities to stop while the pandemic is going on. So it's kind of it's a recession by design. And as a result, a lot of the lessons that we've learned from the past don't necessarily apply. And so it's very hard to come up with very good historical parallels.
Got it. I love that expression, recession by design. I think that will go down in some textbook that I'm sure you will.
Maybe mine.
You're right. Exactly. Moving on from this, I mean, I think most people then immediately migrate once they have absorbed that this is bad, this is deep, this is profound. What is the recovery going to look like? What's your view on this?
Most recoveries are very slow and painful. The recessions tend to leave scars in the economy. I was involved in academic research literature about 30 years ago, which is something referred to as the unit root literature for technical reasons. But it's basically, the whole point of that literature was just saying that recessions tend to be much more persistent than it's easy to explain in standard models. So back in 2008, when we had the financial crisis, I was relatively pessimistic about a quick recovery, and we didn't get one. I mean, it was a very long and painful recovery. So I think it's kind of in some ways typical of a lot of recoveries of being very long and painful. This one could be different. Because, and I said, so the lessons we've gotten from studying the time series of past recessions can't really apply to this because it's a recession by design. And you just kind of wonder, okay, well, given that we're asking people to stay at home, once we stop asking them to stay at home, can they jump back to work? And one piece of evidence that's sort of consistent with a somewhat optimistic view is if you look at last month's jobs report, you can separate out the unemployed between the people on temporary layoff versus permanent job losers. And there were almost no permanent job losers. It was all people on temporary layoff. And that does sort of suggest that people have jobs waiting for them. So the optimistic analogy I try to think about is this. It's a French bistro near my house here, one of my favorite restaurants. A few years ago, they had a kitchen fire and they had to close down for renovations. So they closed down for renovations for, I think, about 6 months. When I came back after they were opened up again, all the wait staff and the bartenders were all the same people. They came back. So I was chatting with the bartender, like, what did you do for 6 months? He said, well, I collected UI and played a lot of golf. And then he came back. He loved his job and he knew he was going to open up again. And so he wasn't employed by the restaurant during the 6 months. He was collecting UI, but he still maintained the connection. So the hope was that this recession could potentially be that. People won't be playing golf, they may be watching Netflix at home, but it's the same basic idea, is that they have jobs waiting for them and they can jump back.
Yeah.
The real risk is if the pandemic lasts longer than expected. As if this is like a 6 month, a 3 month or 6 month shutdown with their jobs waiting for us, yes, it's painful, but we'll get through it. If things get much worse from a pandemic standpoint, and we have to extend the lockdown even longer, and a lot of these small businesses don't reopen, and the temporary layoffs become permanent job losses, that's when the recovery could be much longer. So in some sense, the question of whether it's a quick recovery or a slow recovery is really not a question for the economists. It's really a question for the microbiologists, because I think the economy is going to reflect what goes on with the virus.
Yeah, and I love the example of the bistro right next to your house. I live in New York City, and I look out at the same landscape in many respects, and you see all these small businesses. And the question indeed is, how long is it going to last, and can they sustain it? Are they still going to be there, or only the chains are going to survive? So with that in mind, what do you think more broadly the economy will look like after we emerge from this particular, for the moment, healthcare, from the healthcare from the pandemic?
Yeah, there'll certainly be changes in terms of the allocation across different kinds of sectors. So I've been trying to think about how is my behavior going to change, and how most people's behavior are going to change. I love movies, but I have a hunch that movie theaters are going to struggle even after the temporary lockdown comes. Because they've already been struggling. People are already doing more streaming at home with big TVs and very fast streaming services. So even after they tell me I can go back to a movie theater, I'd be very loath to go into a room with 300 strangers and sit there for 2 hours in close quarters. That just doesn't seem like a wise thing to do until a full vaccine has been developed. So it seems to me that that's an industry that's going to struggle. I personally also worry about some live theater. I love musical theater. I had a bunch of tickets that got canceled this spring. But when will the next time I feel comfortable sitting in a, say a Broadway musical theater with 2,000 strangers in close quarters? I don't think I'll feel comfortable doing that for a long time. So unfortunately, I think there's going to be a lot of changes like that. Restaurants come back. They probably won't come back as closely packed as they have been in the past. So they're going to have to put more distance between tables. Especially, I'm in my 60s, so people sort of my age and older might decide it's too risky. They'll do takeout. So I can imagine a lot of sort of businesses will just be different even after the sort of short run shutdown is over. I think also people's experience during the shutdown is going to change how they behave afterwards. So for example, a lot of people are doing a lot of online shopping. Some of those people may not have done online shopping. There's already been a drift from sort of brick and mortar stores towards online. Some people who have never had switched that are probably now trying it and saying, hey, this is pretty good. And they may stay that way. So one piece of indication of this is the stock price of Amazon. The stock market is overall down for the year, of course, pretty significantly. Amazon stock prices are up like 30% for the year. And that's not only because Amazon's going to enjoy a few months of online shopping. I think people think, this may be a trend where more people are going to feel comfortable with that mode of buying things.
Yeah, I can even from our perspective, from the Cengage perspective, resonate with that completely. I mean, we have moved our entire workforce into a virtual environment in early March, actually ahead of governor's orders, in 24 hours. And now we are actually, digging out of this, and we realize actually there are certain jobs that work virtually, and in fact they work even better. So the behavior changes and the pattern, and there's adjustments as a result of that. Switching gears a little bit, Greg. We used the word probably one too many times in this debate, like unprecedented, right? And it clearly was unprecedented for Congress. But given unprecedented times, and these are elected officials, how do you rate their policy responses so far?
At Harvard, we've continued our courses online. And we've made a decision at the highest levels of the university to basically switch from a A through F grading system to emergency pass, emergency fail. In the grounds that it's very hard to judge people in the midst of an emergency. I think maybe Congress should be judged similarly. So I'd give Congress an emergency pass. I think by and large, they've done good. And it's not perfect, but it's certainly passing. The way I think about it is there's really sort of two broad goals of what Congress just did. One of them is sometimes called stimulus, but I actually think that's the wrong word. It's not really stimulus. It's not trying to get people back to work during the shutdown. I think it's probably better to think of it as social insurance or disaster relief. They're basically saying, okay, when we know a bunch of people aren't going to go back to work, how do we help those people make it through what is going to inevitably be difficult times? And so we have a variety of things like the tax rebates to every adult, expanding unemployment insurance. A lot of these programs are there to basically help people through difficult times, and I think that makes perfect sense. The second part of the thing is business continuity. They want to try to make sure the economy is ready to open up again when the pandemic lets us do that. And there's been a variety of sort of programs that one is just sort of an infusion of a lot of liquidity. So in some sense, the model here was something we learned in 2008. Then in 2008, they passed the TARP program, the Troubled Asset Relief Program. And that actually was a very successful program. It's often criticized as a bailout by both people on the far left and the far right. But I actually think it's a tremendously successful centrist policy where they didn't really bail out firms. They lent money to firms, often on quite attractive terms to the taxpayer. They get firms to survive and make some money for the taxpayer in the end. I mean, the automotive part of it, which was not the initial intent, but eventually used by the Obama administration to help the auto industries, that lost some money. But until then, all the stuff with the financial firms made money for the Treasury and kept the financial system going. This is kind of doing the same thing for Main Street rather than Wall Street, and I think that's really working well. The second part of this is sort of aimed at, in terms of business continuity, is aimed at the small businesses, the Paycheck Protection Program. That I think is a very well-intentioned program that's very badly designed, and we've already started to see a lot of problems with it. Problems that I think were predictable, and I know they were predictable because I predicted them. I was talking to some of the architects of this program beforehand, and I said, the way this is designed, I know it's going to help people out who need money, but the conditions are sufficiently loose and vague and not specific that a lot of people are going to get these forgivable loans for this program, not really fully need them, and end up basically enjoying a windfall. And we're already sort of seeing that, where certain businesses are giving back the money because they're publicly embarrassed. The architects of the program said, there's always bad actors, we're going to prosecute for fraud. The problem is, if you write a bad program, somebody could obey the law and get a windfall. So it's not fraud if you do everything according to the law, if the law is just badly written. And so I think there'll be a lot of stories after the fact that there was a lot of people, there wasn't enough money for people who really needed it, and there were windfalls for people who really didn't. And the program was just very bad at figuring out who was who. Now, the truth is, I don't know how much better they could have done. It's a very hard problem to figure that out, how to target correctly. But I think with hindsight, it's going to be a pretty, I think it's going to get under a lot of criticism. In fact, there was a working paper that came out today, I saw it at the University of Chicago, that said the areas they were having the deepest downturns were not the people getting the most money from the Paycheck Protection Program. There's really no correlation to how much money they were getting versus how big the downturn was. We'll see more studies like that. And let me say one thing that I'm a little critical of Congress. Congress has been very, very afraid of bankruptcy. And so the idea is we're going to shovel as much money out the door to keep everybody from going bankrupt. I think bankruptcy can sometimes be a reasonable response to a crisis. And I know Michael knows a lot about this because Cengage went through a bankruptcy some years ago.
You better believe it.
You're an expert on this. You handled it wonderfully, Michael. But the key thing to mind about bankruptcy is not the same as liquidation. It's not as if all the capital and employment relationships sort of go up in smoke. It's really a financial reorganization of a firm, such as under Chapter 11. It's a financial reorganization. Equity holders get wiped out. Debt holders get taken over as new equity holders. If the business is viable on an ongoing basis, the business can go on. So things like the airlines, I'm probably not going to feel comfortable flying much for the next 18 months, even if the airlines open up again. I suspect a lot of people are going to be in my shoes. So my guess is the airlines are going to go through a very tough time for the next 18 months until there's a vaccine. It's not a crazy thing to say they should go through a Chapter 11 reorganization. The planes will still exist. The planes will still be flown somewhere. But this idea that we have to protect the equity holders from this act of God. And when equity holders get the upside in these public companies, when things go well, and it seems fair to me that they should get the downside when even in acts of God, as opposed to expecting to be bailed out by the taxpayer. So if I were Congress, I'd be a little more open to the possibility of Chapter 11 for some of these big public companies. But as I said at the beginning, they get an emergency pass. I think 90% of what they've done is in the right direction.
Got it. And Greg, you touched on this already, but I'd love for you to elaborate, because I know you have your own sort of proposal around this, which is this notion of social insurance.
Yeah.
And I'd also love for you to comment on not only on the concept itself, but also if we lift our sights a little bit from the US to the global pandemic, and now the US has moved into the center from a healthcare incident and death rate perspective, and a lot of people will be looking at the US. What is the US doing in this respect? What's your proposal around this? And can you tell us a little bit about it?
Sure. At the beginning of this, I started thinking about, okay, how are we going to help people through this? And there was a trade-off here between doing something quickly versus doing something that's well targeted. Right? One thing, the easiest thing to do is just shovel money out the door fast to everybody. That's relatively easy. The problem is not everybody needs the money. If you're a professor, you could teach your classes from via Zoom at home. Well, then you don't really need to be getting a check from the government. On the other hand, if you were running a small business like a restaurant, you really do. And so the question is, how do you get money out quickly, but also do it in a way that's well targeted? And that's the fundamental trade-off. The more you try to target, the more you have to wait to figure out who needs it. So what I said, I had this proposal I put on my blog, what I called ex post targeting. And the idea of my proposal was to send money to everybody. And then for some people, it'll be a loan. And for some people, it'll be a grant. And we're not going to figure out what's a loan or a grant for you until after the fact to see what's happened to your income this year. So if you're like me and your heart's still paying me, then for me, it's going to be a loan. They'll send me some money, and then they'll ask me to pay it back over the next few years, and so it won't be a net cost to the government at all. Whereas if they send money to somebody who lost their job, and that person can then later demonstrate, oh, look, I lost my job, I have no income this year, then that cash payment will become a grant. So I actually I sketched out some numbers on the blog. What I said is, look, let's suppose we give every adult $2,000 a month for the next 6 months. I mean, the Congress plan had, I think, $1,200 once. So this is really quite a bit bigger than Congress proposed. So it's $2,000 a month for the next 6 months. You can think of this as almost like a temporary version of a universal basic income, only for the emergency. That's pretty expensive. So you're going to be sending out the door $3.6 trillion. That's a lot of money. But most of that's going to get repaid, because most of that's going to go to people who really don't need it, and therefore they're basically going to be told, oh, you're just getting a temporary loan. Over the next few years, you're going to pay it back to us. The net cost of it after the repayment is only going to be about $240 billion. So you're going from 3.6 trillion to 240 billion net cost. So I think that's eminently doable, and I think $2,000 a month for every adult would at least bring everybody up to well above the poverty line during the crisis.
Yeah, yeah, very interesting, and an interesting proposal to differentiate, but still act quickly, right? I mean, that's the benefit of what you're saying. Since we're in that bucket of sort of actions taken, the proposed cut in payroll taxes. What do you think?
Yeah, a lot of Trump advisors have been advising this lately, and I don't think they fully appreciate the difference between this recession and most recessions. I think in a normal recession, where you're trying to get people back to work as quickly as you can, a payroll tax cut seems like a reasonable policy to go with. But as I said earlier, this is a different kind of recession. It's recession by design rather than by accident. We're not trying to get people to go back to work quickly. We're trying to provide people relief. And this to me seems particularly poorly targeted, because it's basically going to people who are working. So I mean, the payroll tax cut would go to some combination of me and Harvard, depending on what's the employer or employee side. But for somebody who's unemployed, it doesn't do anything. So it really seems to me to be exactly wrong from a targeting perspective. If you're thinking about the main goal here as being providing social insurance rather than economic stimulus.
Got it. So at some point we're going to get out of this, right? I mean, that's at least the underlying assumption, and most likely this will be somewhat triggered by vaccine availability, or maybe even before testing availability, and then some back to normal. But then we'll wake up, and then we will look at a mountain of debt that the government has created through the actions that they have taken. Are you worried about the government debt as a result of this?
I'm not worried now, but I expect to be worried. And by that I mean that yes, we're undertaking a lot of debt. The deficits this year will probably be the biggest budget deficits as a share of GDP since World War II. But this is not the time to worry about debt. There are times for the governments to run debt, and the standard arguments are that it's time of crises, whether it's time we had extraordinary government spending, like during a war, or when you have an extraordinary downturn and you need to provide relief to people. So I think in the midst of a crisis, running up the debt is exactly the right thing to do. We shouldn't worry about it. But we're going to be leaving this with the highest level of debt since World War II, and perhaps even higher in the World War II, depending on exactly how everything plays out. So at some point, we're going to need to say, well, now we're out of this. Let's think about paying down this debt. And how are we going to do that? I think we need to at some point sit down and really confront some hard choices. Neither political party has really been willing to confront hard choices. I've always understood the difference between Republicans and Democrats. They agree on 99% of tax policy, which is Democrats only want to raise taxes in the top 1%, and Republicans don't want to raise it on anybody. So the 99% agreement. The truth is, I think they're probably both wrong in the sense that we probably need to raise taxes on everyone to pay this off. I actually think, and I think we should consider at the end of this, not now, but when this is all over, is something like a value-added tax, which we know from many European countries raises a lot of revenue quite efficiently, and a small value-added tax could pay off this debt, not immediately, but over the course of many, many, many years. The one piece of good news, by the way, about the government debt is interest rates are very low right now, and according to the markets, they're expected to be low for a long time. That's kind of an interesting question in itself. Why have real interest rates been drifting down for the past several decades? Basically, since the 1980s, it's been a slow, gradual decline. That is probably separate from this current crisis. But what it does, if it continues to be the case, then the cost of servicing this debt going forward will not be that great. And so I'm really not particularly worried about it. There's nothing stopping necessarily interest rates from going back to more historically normal levels. But as of right now, it looks like real interest rates are low, and there's no indication that they're about to revert.
Yeah. And as you said, now is not the time to talk about it. When the house is on fire, you don't debate water prices. You just put the water on it and try to douse it. I get it.
That is a great metaphor, yes.
I get it. It kind of leads somewhat organically to the question of the role of the Federal Reserve. I mean, you're very close to it. What is your sense? What is the role of the Federal Reserve right now, and what should it be, particularly if we're thinking about sort of coming out of this?
Well, the Federal Reserve really has two basic roles. One is to set monetary policy, which is what should interest rates be, and choosing a target for the federal funds rate. And the second is to act as the lender of last resort. In normal times, it's the first role that matters, because we don't need a lender of last resort, because we're not at the last resort. So really, the main issue for the Fed in normal times is deciding whether the federal funds rate should be 2, 3, 4, 5. But now, this is the second role that really comes in. I mean, they have cut interest rates, which is a fine thing to do, but I don't think that was terribly important. What they're really doing is shooting lots of liquidity into the system to make sure that people, in particular firms, financial institutions, who want to borrow have the opportunity to borrow. And I think the Fed's really been doing a very good job here. I'm a fan of the institution of the Fed more broadly, but also of Jay Powell and his team that he's leading the Fed right now. The one thing that's a little different for them is normally when they act as a lender of last resort, it has to do with financial institutions. Like in 2008, the whole crisis was centered on financial institutions, and that's kind of in the Fed's wheelhouse. Now this is really starting more in Main Street. It's not the financial institutions that need the lender of last resort function. It's a lot of the non-financial firms, and the Fed's not really set up for that. So they're kind of working together with the Treasury to provide liquidity for a lot of non-financial firms. And there's a variety of sort of risks here. One is that as the Fed works together with the Treasury, the whole Fed independence thing sort of is called the jeopardy. It becomes more of an arm of the Treasury, and that's presumably not a good thing long term. So we sort of sort that out. The other is sort of credit analysis. The Fed knows how to analyze financial firms and say, oh, we should lend to this one, we shouldn't lend to that one. The Fed's doesn't have a bunch of credit analysts for non-financial firms. That's usually done by the private sector. And so the question is, should the Fed and the Treasury together just try to do credit analysis to decide which non-financial firms deserve loans at what sizes? Should they just sort of provide a lot of liquidity to the financial institutions, let the financial institutions then lend to the non-financial firms, which is, I guess, part of what they're trying to do. The one thing they can't do is say, okay, anybody wants to borrow $1 billion, just come here, I'll write you a check, because there's going to be a lot of malfeasance going on. So you have to do some sort of due diligence, and they're not. They have a brilliant staff of economists, but they're not credit analysts. They're not bankers in the traditional sense of commercial banking. So I think we have to sort of keep an eye on that. The bill passed by Congress said that all this lending that the Treasury and Fed are doing is supposed to have a lot of oversight through some panel, and there was a lot of debate between the Trump administration and the Congress to get this oversight panel in. And as soon as the bill was passed and signed, the Trump administration said, "Oh, we're not going to do this oversight stuff." And I think the risk there is basically the risk of crony capitalism. That there's not enough oversight. It's going to go to politically powerful, well-connected, rather than the firms who need it, and that's really a very slippery slope. We've seen that in a lot of other countries. It's a way for long-term economic decline if you start having the government in the job of credit allocation rather than the private sector.
Yeah. Didn't work all that well in the Soviet Union, for sure.
No, it didn't, exactly.
That's true. Now, I personally trace my ancestry back to Germany, and the next question is actually related to something that the Germans, I know my parents and my grandparents, my great-grandparents were absolutely petrified about, and to this day are, and that's inflation. it created a lot of havoc in Germany after the Great Depression there. Are you worried about inflation in this context?
And there are some economists who are, and I can sort of see what's worrying them, and so I don't dismiss it completely. If you look at the standard measures of the money supply, M1, M2, MZ, they've had quite rapid growth recently, with all this liquidity being injected into the economy. We've also seen a lot of disruptions in supply. Things that's not being produced as fast as can be, as fast as being bought. So I still have yet to go to CVS and find any hand sanitizer on the shelves. This idea where there's some tremendous injection of liquidity, insufficient supply, seems to be a recipe for inflation. So I fully understand why people are worried about that. On the other hand, in a situation where interest rates are basically zero, the distinction between money and non-monetary assets is not that great. So it's very hard to interpret money growth as necessarily being a precursor to inflation. And if you look at the financial markets, if you look at break-even inflation, which is the spread between regular nominal bonds and inflation index bonds, break-even inflation is very, very low. In fact, it's fallen during this crisis to about 1%. So it looks like financial markets are not worried about inflation. So at this point, I'm not worried about inflation yet, but I think it's something to keep an eye on. The other thing, the last thing to say about inflation is that if we do get inflation, it will not be one of our top two problems. That is, even if inflation comes up, I'm still more worried about people dying. I'm still more worried about widespread unemployment than I'd be worried about 5, even 10% inflation. So yes, inflation's a risk going forward, but it's not the sort of catastrophic risk that the mortality and the unemployment risks are.
Pick your battles, I guess, right?
Exactly.
you can only fight
exactly.
so many.
So yes, yeah. And in fact, some people have argued. I have some very good friends who've argued that the 2% inflation that the Fed's chosen, it was too low a target anyway. My friend Larry Ball at Johns Hopkins University has argued pretty compellingly that 4% would have been a better target for inflation. And if you look back at the history of how central banks chose 2%, you get the sense that it wasn't based on like some deep study. It was almost kind of an arbitrary number picked out of the air. It seems like we kind of want price stability. What's price stability? Well, 0 seems kind of too low. It's kind of hard to achieve. Let's pick something low, but not exactly 0. What 2 sounds good. Right. So they kind of stumbled upon it. It wasn't really a deeply thought out strategy. And so if in the end of the day we end up targeting inflation at 4% rather than 2, I think the world will survive.
Bit of a swag there. So let me bring it a little bit closer to home for both you and I, and that is to education. So you coined the phrase which I love, recession by design. Are you going to teach a course on that anytime soon? How is, more broadly, how is Introduction to Microeconomics going to change as a result of this?
Yeah, well, actually, coincidentally, I was on sabbatical this term, so I wasn't teaching this term at all. I had a whole bunch of trips planned to give talks at lots of different schools that use my book and so on.
Oh boy!
My whole spring was filled with trips all over the place, and also got canceled. So,
we would probably be on the same airplanes, Greg.
Exactly. But all of a sudden I got canceled. Now I'm sitting at home, which means I have time to actually revise my intermediate macro book, which I'm working on right now. But I've had more free time than I ever had in my life before, because all of a sudden everything I had committed for this spring has gone away. But I have been thinking about exactly how we teach these different things, what's going to be different in our classrooms. I don't think we really know what to say yet. I'm sure at some point I'll be writing stuff for all my books about how we think about the economics of this, but I think it's still unfolding. But let me sort of give you some early thoughts. We start as you said, Matt. Let's start with the micro, as you asked.
Yeah, let's start both micro and macro.
Okay, yeah. Let's just start from micro. Micro is basically a story about externalities. We talk. I think one of the main examples of market failure in the world is externalities. There's a lot of externalities in the world, and I've spent a lot of my career writing about, say, the virtues of gasoline taxes or carbon taxes to deal with externalities. And in my introductory micro book, I put externalities fairly early in the book, because I actually think if you want to understand why markets sometimes don't work, externalities is sort of the first topic you need to think about, because they are so pervasive in the world. this is for sure an example of externalities. I mean, you walk within 6 feet of somebody else, and especially if you're not wearing a face mask, you're creating a negative externality on that person. And so I think we basically need to sort of fundamentally teach this as pandemics as a story about externalities. I should know, by the way, not all my users of my book may know this, but I have a short module, not in the book, but it's available in the online version, and the digital version, the economics of healthcare. I talk about how externalities are generally pervasive in healthcare, which is why the government is often involved in the healthcare market so much. So externalities is the first thing. So in the language of basic microeconomics, what do you do with this externality? I had a student, I actually gave a guest lecture in a class last week at Harvard, and had a student ask me, so, Professor Mankiw, you've written all this stuff about carbon taxes, how you really love Pigovian taxes rather than command and control solutions. What's the optimal Pigovian tax to deal with the externalities associated with this pandemic? I thought it was a great question, but you think about it, it makes you realize the limits of traditional corrective taxes along the lines of Arthur Pigou. Right? If the ideal Pigovian tax would say every time you stand within 6 feet of another person, you got to pay $1 for every minute you stand there. And if you're not wearing a face mask, it's $3. Right? So that would be the optimal Pigovian tax to correct this externality. But there's no way you could implement that tax. There's no way you could correct for it. You can't measure what you need to measure in order to collect the right amount of revenue. So that you could imagine hypothetically taxes that could correct this problem, but it's probably not going to work in this situation. What that means is that we need to sort of revert back to what economists call command and control solutions to externalities. That's having the government involved in regulating specific behavior. Now, economists tend not to like that in general compared to Pigovian taxes because everybody's situation is so radically different, and people should respond differently to the problem of externalities, that it's very hard to figure out what everybody's behavior should be like. And when you're doing command and control, you need to figure out, okay, I'm going to do regulations on all different kinds of specific behavior, but since everybody's different, I got to have a whole bunch of regulations to tell you how this regulation applies to you. And that requires the government to get involved in a vast number of cost-benefit calculations, right? There's certain obvious things we do, like, they tell the movie theaters to close. They tell you, they don't tell hospitals to close because obviously, one's more valuable than the other at the margin, and so we have different regulations there. But even sort of small things you have to go through. So consider recreation. 2 forms of recreation are going to the movies theater, going to play golf. Those are very, very different activities from the standpoint of the externalities, right? Golf, you're typically far away from lots of other people. You're in a big course. You're outside where the transmission rate is supposed to be lower. So my guess is they should open up golf courses way before they open up, say, movie theaters. And it's almost like a central planning Soviet Union kind of problem. You got to go through every industry and figure out, okay, what's the cost-benefit calculation? What's the externalities associated with this versus the benefits of the activity, and figure out what are we going to open at what paces. And it's not a question that the government's good at answering, but I don't know any other institution to answer that. I mean, somebody's got to answer that. I mean, Georgia, for example, opened up tattoo parlors. That did not strike me as a high priority activity at this moment. Now, I don't have any tattoos. So maybe if I did, I'd understand the importance of getting a tattoo when you feel like it. But it struck me as a thing that could have been put off, and we should have sort of more systematically go through and figure out, okay, well, what are the industries that have less externalities? Like, as I mentioned, golf courses. I don't play golf, but for people who play golf, there's really no reason right now they can't be playing golf. Whereas movie theaters, I love movie theaters, but I can see why you want to keep those closed for a long time. And the government needs to do that, and they need to figure out a way to do that systematically and rationally. And we're not quite there yet. I wish the government would be a little more systematic about it.
And there's an interesting follow-up for me on this, and I've seen it. I'm sure you've seen it in Massachusetts, and we've seen it in New York. The question is, pretty much what you just said in terms of categorizing different businesses in terms of their risk for infection and spreading, et cetera, and the opening schedule is what Governor Cuomo laid out in New York. And, he's coordinating with Connecticut, he's coordinating to some extent with New Jersey. Do you think that the government that you're talking about is going to be the federal government? Do you think it's going to be state by state? And what are the pros and cons in your mind?
Well, different states are different. I mean, there's different kinds of fundamental economic activity. I mean, obviously high density areas, New York City, Boston, are intrinsically riskier than if you live in South Dakota. So that it needs to some sense be different. You know, traditionally, I think that the federal government is sort of has the best experts in things. We have a government now that seems to be marginalizing the experts in some ways. I actually, when I personally watch Andrew Cuomo's regular reports, to me they seem more thoughtful than when I watch President Trump's. So I think we have de facto moved this to more the state level. Probably better if we had some more federal guidance. It doesn't have to be decided at the federal level, but more sort of guidance. And they've done some of that. They put out guidelines, which are some suggestions for the states. And I think that's useful. But I think ultimately it's probably going to be done at the state level, or actually by coalitions of states. I mean, Massachusetts is in the same coalition as New York and Connecticut, and New Jersey. And they're sort of getting together and sort of collectively as a region doing things. And I think that kind of makes sense. I always think they need a good name, those sort of coalitions. I thought they might call them the United States.
I heard that name was taken, but yes.
Maybe trademarked, yeah.
Exactly.
But I think, I'm actually I'm personally impressed with my governor. I think Charlie Baker's really been quite impressive. I think Andrew Cuomo's been quite impressive. So I think some of these, and Mike DeWine in Ohio is impressive. I think some of the state governors have really stepped up in a way the state governments don't always. So I've been actually pleasantly surprised.
And also pleasant to see that this goes across party lines. It doesn't matter whether Baker is a Republican, Cuomo is a Democrat. They just get very, very, as you said, guided by expert opinion and then very decisive in terms of collaboration across boundaries.
Yes, no, I think that's right. That's right. So I think it is sort of the people. There's a sort of coalition of the center right and center left. Like, you know, Cuomo I think is center left and Baker I think is center right. But they're really much closer to each other than either of them are to the extremes of their own parties.
Yeah, absolutely. Let me hit on one last.
Oh, topic. No, I talk about macroeconomics.
Sorry, we forgot that. Go ahead.
I forgot I didn't finish up that last question. Macroeconomics. How do we teach it in a macro class? So in a micro class, it's externalities. And a macro class is about the business cycle. And the one thing to remember about teaching introductory macro is the students are typically 18, 19 years old. So they don't probably remember the financial crisis. The financial crisis was, a dozen years ago. They don't remember. They were little kids, and they probably weren't reading the financial pages. So this is the first recession they've experienced. Now the good news, by the way, is that terrible economic events often generates great economists. There's a lot of great economists have come up in the midst of terrible economic times. Well,
there's hope for my three boys then, I guess.
Well, Milton Friedman and James Tobin both talk about how the Great Depression was the thing that made them macroeconomists, and I'm sure this downturn will generate a lot of interest in economics among people. So you have to remember that our students, this is their first time. This is very formative for them, and this is going to spike their interest in economics to understand this. The first thing to tell them is how unusual this is. They're going to think, oh, this is what a recession is like. This is not normally what a recession is like. This is a very different kind of thing, and remind them about that. I do think some of the tools we do teach in introductory macro are useful for understanding this. You could think of this event as being a contractionary shift in both the aggregate demand curve and in the aggregate supply curve. So they're both shifting in a contractionary, it has a leftward direction. Shift in aggregate demand because we can't go out and spend. I can't go to my favorite French bistro anymore. It's a shift in aggregate supply because the people in my French bistro aren't allowed to work there anymore. So it's both a shift in supply and demand, and that's going to lead to lower equilibrium income. The one thing that's maybe somewhat different than a normal recession is that since it's a recession by design, the target, what you might think of as the natural level of production and employment, is also lower. So while production and employment are falling, it's probably falling in a way that's optimal given the circumstances. And while eventually we're going to get it back up to where it was, that's not something we're trying to do in the short term. So that's one thing that's very different from this recession.
Got it. Makes a lot of sense, and leads me to the broader and frankly one that is, I know, near and dear to your heart and near and dear to my heart as well, which is the impact on education. And, you know, I think you teed up there will be certain subjects people will be interested in. And I also want to broaden it because you're clearly at one of the preeminent institutions in the world. You're teaching there. But we all both know that this is a tiny, tiny fraction of the students in the United States. There are 18 million students in the United States in higher ed alone. What is your prediction, both short term, I would find summer, fall, and more longer term? What is the impact on education that you see?
I think a lot of us are learning a lot about online educational opportunities. I'd never, until this crisis came, I'd never given a talk via Zoom or other sort of video conferencing before. So this is new to me. I think for economics, it's actually worked out reasonably well. There's a lot of economic content can be delivered in this sort of Zoom online format. And I've been quite impressed. In fact, the fun thing is these webinars that people started giving, you can sort of start watching people all over the world. So I've watched seminars going on in Stanford or London, and before I had to actually be there to listen to the talks. Now I can sit in my home and do it. So it's provided lots of opportunities at all different levels. I see here, by the way, now we have well over 1,000 people listening to this. I don't talk to 1,000 people that often. So it provides really an educational opportunity that's not available. It's not ideal because I think it's much harder to maintain student interest on screen than it is in person when you walk around the room. There's something about live events that are different. Same way that why are people willing to pay more for going to a Broadway show than they are to a movie theater? It's because something about live people in front of you makes it more real, more visceral, keeps your attention better. I don't fully understand, but I'm absolutely sure that it's true, and I'm sure that's why sort of the live in-person teaching is going to be something that we're going to need to go back to. In terms of my own institution, by the way, the thing I am most concerned about is the loss of the residential experience. I didn't go to Harvard, I went to Princeton, but sort of similar kind of institutions. My experience as a student was I learned as much in the dorm hanging around with my classmates as I did in the classroom hanging around with the teachers. And the teachers were great. I had fantastic teachers at Princeton, but I just had great fellow students, and I learned a lot over meals, you know, late at night drinking tea or something maybe a little harder. It was just an important part of that, and I am worried that taking online courses sitting in your parents' house is just not the same thing. I'm involved in a variety of other institutions besides Harvard. You know, I'm on a board of a K through 12 school. My wife is on several boards of educational institutions. So I've been seeing how other different educational institutions have been faring, and it's very, very different across schools, across grade levels, across disciplines. So in this school that I'm on the board of, they're having the most trouble in K through 2. Trying to get a kindergartner, first or second grader to sit in front of a screen and get an online education is pretty challenging. And what that does is it basically puts the parents in a position of having to take on a lot of the responsibility, which is really a shame because parents aren't necessarily up for it. They're not trained as teachers, but they may also have their own jobs. Either they have to go to or they have to work from home. And so it really puts everybody in a very difficult situation. And that's really very unfortunate. My son, the younger son is at art school. He's at RISD. And he went and he spent some time at the Walnut Hill School, which is an art high school. And the art schools are also, there'll be more trouble teaching, I think, online than say economics. You teach an economics lecture online, it's very hard to do an art studio online. Imagine you're trying to teach a class in modern dance or ballet. How to do that online? You just can't do it. Yeah. My daughter is actually in medical school. She was supposed to be doing rotations this spring, following basically doctors around hospitals. Yeah. Those got canceled. She's taking they have some online courses for them, but the basic act of learning to become a doctor has to be done to a large extent in person with patients, real doctors. Now that the patients are all primarily COVID patients, and so the elective stuff has been gone, and the doctors are overwhelmed about that. So they don't really have time for the teaching aspect of it. That's been seriously compromised. So you see big challenges, which economics is not struggling too much. I think eventually we'll need to get back to normal, which is doing things in person. I don't know when that's going to be. I'm guessing it's not going to be 100% in September. Harvard's already hinted at this. They haven't said what they're going to do, but I'd be surprised if 100% of the students are back in September.
Yeah.
I've wondered what they should do, whether they should delay and start in the middle of the semester, excuse me, or maybe they should bring back only half the students. One thought I had is maybe bring back the freshmen and the seniors, and so they can each have their own single. So the dormitories and the dining rooms won't be as packed. They can social distance more. So you can imagine, so doing only half the classes online. So you can imagine different possibilities. I think they're exploring that now. I don't think anybody quite knows the answer.
And I think, Greg, what you are just describing, the scenario planning that Harvard is going through, is certainly from where I'm sitting and talking to presidents of, large systems, from community colleges to, private higher ed institutions. Everybody's going through the same thing, and there is obviously a healthcare overlay. What you said about movie theaters, a lot of people will say about football stadiums in a college, and the likelihood that they are not going to open. And I think there is a scenario that I wanted to get your reaction to that admittedly sounds a little bit extreme, but then again, we have been surprised in many respects. So about 30% of community college students actually work on the side. They are not your typical Harvard students, 4 years they're sitting there. 30% of them work. 7 million students is like 2.5 million students of that. Many of them have spouses. Many of them have lost their job temporarily or permanently. There is a scenario that these students will say, look, I'm not even sure whether whether the facilities are going to be open, number one. I'm not sure I love the online learning experience. To your point, some topics are easier taught online than before. And I'm not sure I can afford it anymore because, my income level has dropped. So on top of a record level of unemployment that undoubtedly we're going to see in the fall, there could be a scenario that we're going to see a record dropout rate from the higher ed institutions, which is kind of counterintuitive given that this should be a great opportunity for people to actually reskill and upskill. Yep. Do you think that is too extreme a picture to be painted, or do you think that's realistic? And is there anything that the government or we as a society should be doing about that?
That's a great question. I mean, traditionally, higher education is countercyclical. In recessions, people do tend to go back, take courses. But if the courses aren't the same because of the particular circumstances of this economic downturn, then you might see an historically unusual pattern. I actually think there's a little bit of money in the CARES Act for higher education, not very much. I think trying to encourage people to do this and try to figure out ways to do it better. I think we will get better at it, by the way. I think we're learning about how to use these online resources, and we'll do it more over time. And I think this event is just like it's accelerating people to start shopping at Amazon rather than brick and mortar stores. I think it's going to accelerate learning how to use online resources. So to give Cengage a plug, there's been in my introductory textbook, there's been a gradual movement over time for more and more students to be using the digital version of the book rather than the hardcover version of the book. When digital versions came out, I was personally skeptical because I kind of like books. But in my last few years of teaching introductory economics, I switched to using the digital book, and students liked it, in part because it was very convenient for them. They could pull it up anytime they wanted to on their laptop or smartphone. And in part because it has all sorts of functionalities that you can't put in a physical book. So I think what we might see is people trying new digital learning experiences, and we'll get better at it. And for those who are teaching out of my book, and I know there's a bunch of people in this audience who teach out of my book, if you teach out of my book and you haven't checked out the digital thing, contact Cengage and they'll tell you how you can check it out, because you might decide it's a better experience for your students. I still have very fondness for physical books. In fact, I have my copy of my physical book right here. I still love physical books, but it may not be the teaching method of the future.
And Greg, I would say from my own perspective, I like physical books as well, and it's not necessarily an either or. In other words, there's something that you can do with a digital platform. Your book is a perfect example with MindTap that is appropriate for the student to do on the phone. But then again, if they want to read an entire chapter, they probably want to read it in print. So what we're trying to do is give them the mode that actually makes the most sense given the use case, rather than, there's only one way that we're going to teach it. So absolutely. And we're seeing and I mean, in the middle of the pandemic, what we have opted to do is basically open it up to everybody, because we know that people were in need, and we're seeing a terrific uptake of the digital features and functionalities. So
that's great. It was very nice of you to open up for free to everybody. So that's really terrific.
Thank you. Greg, thank you so much. I can only tell you from you sort of glancing at the chat activity there, your comments have sparked a tremendous amount. I would almost call it an avalanche of comments, questions, etc. We will do our level best to answer many of all of them. In fact, I'm also seeing that you have already proactively addressed many of them in your comments. So, we'll get a better sense from the audience as to, what the reaction was, etc. But I can tell you on a very personal level from my vantage point, I tremendously enjoyed this discussion. I think I felt it was badly needed for me, a voice of reason with some balance, as opposed to watching cable news at this day. And I greatly appreciate your insights and your perspective on this. And I'm looking forward to doing this again, hopefully not with another, design recession, but in some other circumstances. Thank you very, very much.
Thank you, Michael. It was a pleasure.